We continue today and hopefully finish chapter 4. After chapter 4, the plan is to spend about a week and a half or 2 weeks on problems. Solve a few problems from chapter 3, and then solve a lot of problems from chapter 4, and then have a quiz on chapter 3 and chapter 4, mostly problems. Alright? So, alright, please, quiet. We had 5 different types of ratios, right? And last time we covered 2 types. One is, does the company have money, which is liquidity? And number 2, does the company make money, which is profitability? Next one, number 3, is, for here it's section number 2, it's page 101. Page 101, capital structure. Guys, enough talk, please. I don't want to hear people talking. Capital structure ratios. Capital structure, yes, I can use my red color. Here, the word capital, means how the company finances itself. Capital means source of financing. And capital structure tells you how the company finances itself. It represents the ratio of essentially debt to equity. Equity as in owner's equity. So capital structure tells you debt to equity. Now, increasing debt basically means increasing risk. If you have more debt, you have to make more interest payments. And if you make more interest payments, if you don't have profit, if you don't have revenue, you can get in trouble. Companies without debt typically don't get bankrupt. Companies with a lot of debt get pregnant. Get bankrupt. Okay? So, debt is known in finance as leverage. It means that if you make profit with debt, you make more profit. You magnify the profit. If you make a loss, you magnify the loss. So, let's get on and see what we have. Well, we have what's called the debt ratio. Okay, use the big one. And the debt ratio is simply total liabilities. Total liabilities, we can just say for short, debt. Debt. To assets. $10 or 20% of debt, we call this now debt financing, is okay, it's normal, it's healthy, doesn't cause a problem. 50% debt is usually a cause for concern. And 80 or 90% debt usually means trouble. means that the company is in serious trouble. Okay, so here you want to see a healthy debt ratio of 10, 20, 30%. But of course, you always compare to the benchmark. For example, banks, commercial banks, use a lot of debt. You know, they are hungry for profits. They like to borrow a lot of money. So when they make a little return on their assets, 2 or 3%, a debt ratio of 90% will magnify the profits 10 times. We'll probably see some examples later on.
So can you re-explain the leverage?
Leverage is simply a multiple for the profits or losses. A multiple for the profits or losses. Whatever the loss is, with a high leverage, all right, with a high leverage, you have a high loss. Okay, let's do this. Special, right? The following. You buy a house, you guys all do, and the house is 100,000 US dollars. That's the same as, I'll make it short, the 3 zeros I write as a K. K means 1,000, okay? And you bought the house with how much debt? 50%. So, debt equal to 50K, equity equal to 50K, okay? And now, the price, this is the purchase price, the price goes up by plus 10%. What's the new house price?
110.
110. If the price is going up by 10%, $100,000 plus 10% gives you 110K is the new price. Now, what is your return on your equity? On your equity. Your equity went up. Equity. So we say change in equity is up from 50. 50 is your original equity. Your new equity, when the price is 110, you subtract the debt of 50, becomes 60. So from 50 to 60, guys, I'm missing here the little K. K equals to what percent? What is the percent return on equity? 20%. From 50 to 60, you got an increase in equity of 10 on a base of 50. That's 20%. All right, now let's summarize. Let's summarize. You got this part. This is the price of equity, the price of the house. If the house goes up by 10%, your equity goes up by 20%. All right, let's try something else. Let's say the house goes up by 30%. 30%. Okay, house goes up by 30%. Let's make the calculation on equity. Now, house is 130. Your equity, your debt was 50. Your new equity is 80. From 50K to 80K, the percentage return is
60.
60%. So 60% plus 60%. All right. So what we see is 10% in the price of the house increases your equity 20. 30% of the price of the house increases 60%. Now a very, very easy calculation. Plus 50% on your house means that your house price now is 150. Your equity, your debt, that's the debt is 50. Your equity is 100. Your equity went from 50 to 100. That's a plus 100% return. When the price goes up, leverage is a beautiful thing. You get rich quick. Now comes the second question. What about a loss? Well, suppose the house price goes by, I'm going to draw a little line here just in case, minus 20%. In a minus 20%, what's the equity? First of all, what's the price? In a minus 20%, your house goes down by 20%. So from 100, the new price is 80. Debt is still 50. Your equity is 30. So 30 is your new, sorry, my mistake. 30 is your new equity. The old equity is 50. You lost 20 on 50. That's minus 40% loss. Minus 40% loss. Okay? It's that simple. Alright, so here a debt of equity ratio to 1. Leverage in this particular case is 2. Leverage 2. Leverage 2. Leverage 2. So whatever the profit is, the price goes up, the equity increases double, or the equity falls double. Now let's see very quickly what happens exactly when you got a much larger leverage ratio. Now let's do the same house. And for the same house, let's make the debt equal to 90. And the equity is barely 10. This means that the debt ratio is like 90%. So this means that leverage is 10. Let's do the calculation. Your house went to up plus 10%. Your house is now 110,000. Okay. Your equity goes up from 10. Now the new equity is 20. So your house is 110 minus 90 for the debt. Your equity is 20. So from 10 to 20, your return is plus 100%. That's how Donald Trump makes his billions. He borrows 90 or 95%. A little increase in the price of the house of 10% doubles your money. An investment of 10 million becomes 20 million. Well, now, what about a minus 10%? The price from 100 will fall to 90. Your debt is also 90, which means that your equity is 0. When your equity is 0, this means that equity from 10 going to 0 is minus 100%. It means you lost all of your money and you go bankrupt. And that's what happened long time ago to Donald Trump. He technically went bankrupt not once, twice, because he invested with a high leverage. In this particular case, it's 10. Now, what does it mean, a leverage of 10? It means that when you have the price of plus 10%, when you multiply by a leverage of 10, gives you plus 100%, gives you the gain. And if the price is if the price change is minus 10, multiplied by 10 is minus 100%. Alright, so basically, you can make a lot of money with leverage, but you can lose a lot. You can lose even more than what you invested in. Okay? And that's how most people go bankrupt in what's called a real estate bubble. When real estate prices go up, and up, like they've done in the last 10 years in Thailand and Hong Kong and Singapore and South Korea and China and Cambodia and all of Asia, okay? When people buy close to the top with a lot of leverage, okay? A small fall in the price of the house bankrupts the family. Okay, that's very simple but important to understand. Is it kind of like answering the question? So, debt, we say, is a double-edged sword. Meaning, on the way up, it's a beautiful thing, and on the way down, it's an ugly disaster.
Do we consider the interest that you have to pay back as well?
Well, in this particular case, no, but when you have a business, and we'll probably have a couple of chapters later, again, you factor in the interest. So your interest, let's say if you have twice more debt, your interest doubles, okay? And then a small profit can turn into a loss with a higher leverage. So instead of debt having 30%, you got a 60% debt. So your interest payment, instead of a certain amount, is double the amount. And if your interest expense is twice, this means your profit falls. And if the profit is small, high interest can turn into a loss. We'll be getting to that a little later. Right now, again, I am trying to get you focused on those ratios, and then we'll connect maybe debt to profitability down the road. Right now, let's see what's the next ratio I need to cover. Oh, next ratio is times interest earned. Okay, that's a nice ratio. Will answer a nice question. Times interest earned. It's actually a very simple business question. Tell me what's my profit, how much profit I made. In this case, it's before interest and taxes. We call this operating profit. And then tell me what's the interest or interest expense. It's the interest expense. Let's just use a simple example. You made a profit of $100,000, okay? And your interest expense was, let's say, $60,000. So you made almost twice your interest. You made the cost of interest almost twice. So if 100K and the interest is 50, your ratio is simply 2. In other words, how many times you covered your interest expense? It's actually a fairly simple question in real estate. In real estate, you buy a house, and in the house, you got a mortgage payment. Let's say you bought a house, $100,000. In a $100,000 house, let's say the payment is $500 per month, okay? And so a payment equal to $500 a month. I'm making a rough number. You will be calculating in chapters 5 and especially chapter 6. Let's say that the principal is, let's say, $50, and the interest is $450. Okay, and you're charging for the apartment a rent of $500. If you're charging a rent of $500, the revenue, the earnings before interest and taxes is $500, and your interest expense is $450. So this gives you what? About 1.1. Or like 1.11? Okay, so you barely covered your interest expense. You're just working for the bank. Okay? You're making the bank rich, meaning you want to work in the bank, not for the bank. It's a big difference, right? When you're in the bank, you pocket the money, right? You work for the bank, you pay the bank, and somebody else gets rich. In this particular case, when you buy an apartment, that's how it goes, okay? All right, so here is, let's jump to a completely different subject that these guys are taking with me. What is the normal times interest earned ratio in a healthy real estate market? In a healthy real estate market, the times interest earned ratio is about approximately 2, okay? If the ratio is 2 is healthy. 1.5 is overvalued. All right, let's do some real finance over here. If the ratio is 1, it's a giant real estate bubble that when it crashes, it burns. And if the ratio is about 3, let me clean this mess up. The real estate is undervalued and a good investment. 3, real estate is undervalued and a good investment. So, now, you got your investment. You purchased a house, the investment for $100,000, okay? And your monthly payment, let's say, is about $550. That's the monthly payment for the bank, of which about 50 goes for principal and 500 goes for interest. All right. So, now the question is this a good investment or is it a bad investment? And the answer is, it depends on the rent. If the rent is, let's say now, rent. I'm trying to see how to do this. Okay. Here. Suppose the rent is $1,000 on the apartment. What's the times interest earned? You earn, you don't need a calculator. Your interest is 500, your rent is 1,000. So the times interest earned is 2. If you're able to rent your investment for $1,000, this means that it's a good, healthy real estate market and you made a good investment. If you're renting for $750 and your times interest earned ratio is 1.5, this means that you overpaid for your real estate. Your real estate is a little bit too expensive. Paying $100,000 for an apartment that rents $750 is not really a good deal, okay? Now, if it's $1,000, it's a very good deal. Means it's a normal, healthy. That's what most of the times real estate pays, okay? It usually pays twice. Now, if the rent happens to be, like where I'm living, $500, and the apartment is $100,000, the ratio is 1, and this is indicative of a real estate bubble. It's way, there's E here, but I don't have the space to write, okay? So this means that it's way, way, way overpriced, okay? So when you have a ratio between the price and the rent, we always say that the rent is the correct number, and the price can go up and down a lot. Because the price is affected by credit. It's credit what drives the bubble. So in this particular case, this is not a good investment. It's not a healthy investment. If it's a business, it's not a healthy business. The business is sick. It's almost dying. Okay? All right. So it's just a bubble. They say, well, but maybe the price is going to go up to 110. Well, yeah, but maybe the price is going to go down to 90. Okay? In generally, you're barely recovering your interest. Okay? It's not a good investment. So this one here is this one. This 1.5 here is this one overvalued. This is the overvalued. And this means it's a good. Now, real estate will be a great investment when the rent is $1,500 and the interest is only $500. Okay? So you got to compare the revenue. In this particular case, the revenue is associated with the earnings to the cost. Let's see. Is it first this part clear? All right. Well, for you, you need to figure out where currently your real estate market in your town, wherever you come from, is relative to rent. In other words, what's the bank payment and what is the rent? Okay. Well, that covers it. Number 2, okay, I got it. Okay, I'll just move over here. And moving over here, the next one is asset management. That's number 3, asset management efficiency ratios. In my case, it becomes 4, asset management efficiency. For all the people with a textbook, page 102. Page 102. Okay? So what are the ratios? Total asset turnover. Now, before we did something amazingly similar, it was the inventory turnover. How many times we turn over the inventory? Now is how many times we turn over all assets. So let's see how it goes and where's the ratio. So you got turnover means sales. This is the same as revenues to assets. Okay. Now, if it's inventory turnover, it's going to be sales to inventories. So, the inventory turnover will tell you how efficiently we use inventory. Here, how efficiently we use our total assets. Okay? And another ratio? Oh, fixed asset turnover. Fixed asset. The logic is the same. Isn't up there sales? Is it sales? Huh? Sales?
Yes.
Okay, thank you. So, for the inventory turnover, the denominator was inventory. For the assets is assets, so this has to be fixed assets. Is it? Okay, that was easy. Fixed assets. So, how many times you turn over your assets is how efficiently you use your fixed assets. Maybe you have too many fixed assets. In other words, your office is way too huge and they got very little shoes inside, okay? And you're not making a lot of sales and your office is too big. All right, let's see. The next one, if you remember, already covered. That was the profitability. And the last group is, where's the last group? Market value. Which page is the market value? market value ratios. Can you see which page is the market value ratios? 92?
It's a different version.
No. Where's that? It's not 92. Asset management ratios. Next one is liquidity. Is the financial leverage. Okay, page. Guys, 113. Page 113. Page 113. The one is price earnings ratio. In a price earnings ratio, you take the price of a share. These market value ratios require that the stock, the company is traded on a stock exchange, and you get a price for the stock. So it's simply price divided by earnings. Okay? What's the price? The price is per share. Okay? And the earnings are earnings per share. Okay, so you take the price per share, I just call it price for short, and then you take earnings, which is earnings per share, okay, and it tells you how many times you're willing to pay for a unit of earnings. Alright, let's try this. Suppose the price earnings ratio, we call it, sometimes they write it like this. Price earnings ratio is 3, 5, 10, 20, 30. If you're investing in a stock, is price earnings ratio of 3 good or very good, or bad or very bad? So you go on the extreme, and 30. Is price earnings of 30 good, very good, bad, very bad? You gotta actually think. You just think. What is the price and what's the earnings? Good or very good? Bad or very bad? For 3. 3. You pay 3 times. So the company makes $10 and you pay 30. Here, the company makes $10 and you pay 50. The company makes $10 and you pay 300. This is like perfect. This is like excellent. Ratio of 5 is very good. Ratio of 10 is good. Ratio of 20 is bad. And ratio of 30 is like very, very, very bad. Now, what is the meaning? What's this ratio mean? It means, answers a simple question. How many years it takes you to pay your money back? So if you invest, let's say, and it costs 30, so you pay $30, you earn back 10. This means that it takes 3 years to get your money back. Here, it takes 5 years to get your money back. This is 10 years. But this is 30. This is a really bad investment here. I mean, gotta wait for 30 years. You're really hoping that the earnings will grow. So you won't be investing much here. There will not be any investment. It makes no sense to invest unless the company you expect or investors expect to have a lot of growth. Okay? So if you think the company is going to grow, you may pay 20 times earnings. Okay? So typically, 15 times earnings is considered overvalued, meaning you're paying way too much for it. Okay? And 20, 30 means you think this company is going to be discovering something. In other words, somehow you expect this company maybe making a little money now, but somehow it will be, you think, or the market thinks, will be making a lot more money in the future. Maybe they'll triple their earnings and you're going to be okay. Maybe they'll increase the earnings 5 times. But maybe not. Okay? So yes, you're betting on growth, but this is kind of like risky. It's riskier. You better buy it where the earnings are big. Okay? So, what about price earnings ratio for a house, right? You may want to make an investment, okay? What's a good price earnings ratio? Now, we have exactly the same ratios for real estate, okay? But I'll convert them for easier and simpler because that's how everybody in the investment world thinks about real estate, is the price earnings on a monthly basis. So, a price earnings, we say that real estate is fair, meaning not too bad, not too good, if the price earnings ratio is 100, meaning that the price to rent, price divided by rent is 100. Okay? So, if your house is $100,000, okay, the monthly rent should be $1,000. So if you can rent it for $1,000 and the house is $100,000, that's a fair to good investment. If it's 50 to 80, which happens, this is very bad or very good. Anyone? Again? I can't hear. Do we want to pay 50 or 100? Which one is better if you're the investor? You want to buy the house? Look, guys, this 100 means it takes 100 months, about 8 years, to get your money back from the investment. Okay, you pay 100,000, you collect 1,000 in rent. This means in 8 years you get your money back. If it's 50, it means you get in 4 years your money back. And then everything else after that is a pure profit. So this is like excellent. This is like excellent. Let's say 120 to 150 is bad. And if you have more than 200, it's like horrible. As in a real estate bubble. Okay? This is how you measure. Well, okay, where we get these numbers from? Well, back in the old days, 2,000 years ago, Rome was an empire, a civilization with writing and recording. We got only 1,000 years of recorded history, both prices and what they rent. That's easy. Great Britain pretty much got civilized somewhere after the year of 1000, or 1066 when the French conquered it, whatever the story is. So for Britain, we got just about 1,000 years of history of real estate prices. Now we got some other European cities like Paris and whatnot, 400 or 500 years of nice good history. And in the United States, especially New York, you got well over 500 years of history, well, 400 some years of history of New York and New York prices. So based on most or all of Western civilization, based on a few hundred to thousand years, that seems to be fair. And we see similar observations in Japan and in China, so that we know Asia is not an exception. Fine. Money is money, whether you're Asian or black or African or European, it doesn't matter. Real estate prices and money is money the way it works, okay? Independent of your religion, oh, but we're whatever, Buddhist, or but we're Muslims, or no, we're Christian. It doesn't matter your religion, or your race, or your culture, okay? That's important to understand. Well, let's see what else we got, and so that I can finish that little chapter over here. Financial leverage, liquidity, leverage. Okay, number 4. This is page 119. I already did. This is big, number 4, page 119. You need to select the benchmark. So you can do, I wrote it somewhere, trend analysis. I did that a while ago, like 2 lectures ago. And the other one is called peer group. You compare a bank to a bank. You compare a finance company to a finance company. You compare an automaker to an automaker. A computer maker to a computer maker. So, peer group. Comp stands short for comparisons. And I got section 5, and I am eager to finish this. It says limitations. In other words, limitations. A lot of times, students, and especially in banks, they get to believe that, oh, if you do financial statement analysis is a great thing. The answer is no, not at all. Not at all. It's got too many problems. All right, let's do here. Let's move on camera over here. And I'm going to draw a line here. So what are the limitations as in problems? That's usually a very good question for an exam. Problem number 1 is benchmarking. How do you select the benchmark? Where's the benchmark coming from? Okay, that's a problem. Again, part 2 is related to part 1. Published, yes, question? That's page 121. 121. 121. Page 121. You guys see it here? Okay. Number 2, published benchmark may not be representative. So, usually benchmarks for different types of groups and industries and companies are published. So, published is not representative. That can be a problem. So somehow the firm you're analyzing is special, is unique, is a little different. It's not like all the others. So when you get the benchmark, it might not be quite appropriate, okay? So that's number 2. Number 3, when you're comparing the benchmark, you are getting an average. And the average might not be appropriate. Do we want to compare you to the average student, or want to compare you to the best student, right? Well, You want usually to compare relative to the best, okay? You want to select a nice, good company or a few number of companies that are really good. So you want to compare to the best, not just to the average. The average company in a competitive industry may be losing money, okay? And you're going to be comparing yourself to a loser, okay? It's not a good idea. So, just because you're getting average, average might not be appropriate. All right, let's see what else we got. Oh. Number 4, just because you're analyzing, different companies, different businesses have different accounting. So accounting is in accounting practices differ. Some companies, we say, use aggressive accounting where they overestimate sales, underestimate costs, inflate their profits and profitability. So their accounting is a little bit on the aggressive side, or just plain phony or fraud, okay? Or a company may be conservative. They are using a lot of good expenses, meaning they're expensing everything. They may be depreciating a lot and reducing the profits. So accounting, remember we studied this a while ago before, what is a good accountant? Good accountant is, when you ask a good accountant, what is 2 plus 3? The answer is?
3.
No, the answer is, how much do you want it to be? 2 plus 3 could be 4, could be 6, could be 8, could be 1. It depends on what you want it to be. If you want it to be 7, a good accountant will make it 7. And if you want it to be 4, a good accountant will make it 4. In other words, accountants play accounting games. And you don't know when you're analyzing what's the game that they're playing. Number 5, different companies for different reasons, and sometimes in the north and in the south, have seasons. Seasonality. See, winter, let's say up north, is different and becomes summer, let's say in Australia. So you may have seasonality, or you may not have a seasonality. Or you may have New Year's Eve, which New Year is not New Year in China. New Year in China is in February, okay? And it's a completely, what month is New Year in Cambodia? April, all right, there. So you may have seasonality related to New Year, and you may have seasonality related to Christmas, or not have a Christmas at all, okay? In Muslim countries, there is no Christmas, okay? So, again, there may be a particular seasonality that you gotta be careful about, specific to the country. And then, okay, understanding the numbers, okay? This is, I already explained. These are just clues, not clues, meaning these are not answers. These are not answers. These are just clues. All right. Let me see. I'm pretty much done. There is one there ratio. We'll skip. Maybe we'll do. Maybe we won't do. That's good enough. We're going to take 2 or 3 minute break. We finish with this thing.